Welcome to the Financial Freedom Show with your host, Brian Connors, a certified financial planner and investment advisor representative with NPB Financial Group, LLC in Irvine. We're all going to arrive at our retirement years, but the question becomes, do you have a plan once you get there? Stay tuned as Brian will help you navigate the important financial matters that you need to be aware of when it comes to your retirement. For example, not outliving your money, protecting your wealth, investment strategies used by financial gurus to create wealth, reducing taxes, and protecting and caring for your loved ones. So pull up a chair and join Brian for this informative discussion.
Welcome to the Financial Freedom Show. I am Brian Connors, Certified Financial Planner and Investment Advisor Representative with NPB Financial Group in Irvine, California. I'm excited today because with me today is Therese Chanel, Long-Term Care Sales and Marketing Manager with CPS Insurance Services, talking about an important matter that will affect us all, our long-term care. Therese, welcome to the show.
Good morning, and thank you, Brian. I'm very happy to be here.
Thank you for joining us. So why don't we start with just talking a little bit about yourself and, talking about your journey a little bit and just give our audience a little bit of better color about why you're doing what you're doing now and how you got there and just give a little bit overview.
Sure. I got my start at Merrill Lynch in the estate planning department, so I've sold across all lines of business, was securities licensed. After 10 years there, I was recruited by MetLife to help start up their long-term care sales desk. And it was then that I made the decision to focus entirely on long-term care. With my estate planning background, I really became aware of the need to protect the assets. People spend their entire life building up their retirement so they can retire and do whatever it is that they want to do. But a long-term care illness can seriously impact their ability to enjoy their financial freedom.
And it's interesting because, some few people are really talking about it these days. I mean, we all hear a lot of things in the news about retirement. And there's something about, the notion or the topic of long-term care, which obviously is not very popular in most people's minds. Certainly not what they really feel comfortable, really want to talk about or envision about. So what is going on in long-term care these days, and why should people be concerned about it?
Well, I mean, the statistics speak for themselves. The latest statistics tell us that 79% of people over the age of 65 are going...
70%?
79.
79%.
79%.
Wow.
The old stat was 70%. It has now jumped to 79%. That is 4 out of every 5 people are going to experience what I like to refer to as an extended healthcare event. If you start with long-term care, most people equate that with a nursing home.
Right.
No one ever wants to be in the nursing home. So long-term care insurance, having a policy, actually enables you to choose where you want to get your care. So you can be at home for as long as you like, in an assisted living facility. And if need be, then yes, there is also coverage for a nursing home.
Go ahead.
So anyway, like I was saying, most people don't want to go into the nursing home. Most people don't want to think about getting old, aging. It's not a comfortable topic. And when you start getting into care, nobody wants to think about that. Nobody wants to think about even dying. But most people know 10 out of 10 die, so,
Yeah, we're all going to get there eventually.
But we are all going to get there eventually. We all have to face the aging issue, and it's not necessarily some catastrophic illness. It may not be the stroke. It can just be something as simple as just the frailty that comes with aging. As you get older, you just don't have the same strength that you used to. Sometimes you get arthritis in your hands and think about just trying to button buttons or wash your hair.
Right. Yeah, and so it's really interesting, Therese, because my whole view of the subject has changed quite dramatically over the last several months, as you and I have talked about this several times. And I used to think as a financial advisor, most of it was like a linear kind of progression of what we kind of raised awareness and concern to our clients. Particularly the number one most important concern for most people today is, how are they going to retire and what is that going to look like? And are they going to have enough money, or are they going to outlive their money? And so shoved to the backside of that discussion has been, well, down the road, who's going to take care of you? And then in recent scenarios or examples of my clients, I'm experiencing situations where now one of the particular parties to the relationship is now in a long-term care role of a provider and giving the care, which is quite the opposite of what most of us envision. We think of it, well, first we retire, we have a great time, it's retirement bliss, and we enjoy ourselves, we vacation. And then somewhere down the road is that event where the health event like you talk about, we start to get areas where we're going to need some other assistance from other people. And we start talking about that in terms of who is that going to be. And the traditional names come up, family for one. And that's kind of interesting in itself, because I think that's not really reality as far as I know. It's more so it's going to be someone else besides a family member for different reasons. And so what are you experiencing in that area with particularly your advisors and agents that are talking with clients?
Well, pretty similar to what you just described. I mean, most people, like I said, they spend their entire working career putting aside money, building up their retirement nest egg, so they can retire and do whatever it is they want. We all have our retirement dreams, whether it's to buy the sailboat, sail around the world, golf, all the great golf courses, right? But they have a plan in place for that.
Right.
But nobody thinks about protecting that. I call it portfolio insurance.
Right.
Most people, right, think that they're just going to sail off into the sunset, enjoy their golden years, and then they're going to die in their sleep. That's it. That everyone's retirement dream. If you ask anyone, hands down, that's exactly what they want to happen. But unfortunately, the reality of that is most people do not just die in their sleep. There is an illness, there is frailty, maybe a cognitive issue that comes along, and that's just part of aging. And it's a hard subject to broach. Most people do not talk about it. And I'm hopeful, part of my passion and my mission in life is to get people talking about this. People think that their family members are going to take care of them, or their spouse.
Right.
And that's great. Their family loves them. Their family wants to be there for them. But geographically speaking, we live in a different society than we did, 20, 30, 50 years ago.
I know my family, we're spread out all across the country. So, I mean,
Right.
it's impractical to think that I will be able to at all help my mom. It's not going to happen.
Right, exactly. So if people think they're family, my first question to them is, well, have you had this discussion with them? Do they know this? If they're local, are all their children employed? Most likely the answer to that's going to be yes.
Right.
So then which one of their children is going to be able to cut back on their work week or quit entirely to be able to provide that care?
Right.
Well, they haven't thought about that. Now that's a big financial burden on their children. That's not really what they intended. Then they think maybe, oh, well, my wife's going to take care of me. Well, of course, right? She wants to be there. She's going to love her husband. She's going to want to care for him. But can she lift him now?
Right.
Of course
Right.
not. And then what about when you're 80? There's no way.
Yeah,
And
there's
then
people
again-
that we know personally, right, we've had that experience with.
Right, exactly. My own mother, just last Thanksgiving, she was over. She slipped out of a chair and fell onto the floor. Now,
my God.
my first question, of course, was, are you okay? And she was fine, thank goodness. She did not hurt herself. But then the issue quickly became, how do I get my mother up off of the floor?
Right.
My mother is quite heavy. And there was no way I alone was going to be able to get her off of the floor. She really couldn't help me very much.
Right. That's scary.
And it was scary.
Yeah, really.
It was
it's frightening
scary.
to think about that that she's in a vulnerable spot in her life and that she can't do anything to help herself. And then here you are trying to help that person and trying to do something for them where maybe you're just physically incapable of doing it.
Exactly.
I had a scenario not related to long-term care, but just a friend, tall guy like myself, fell down next to me. He kind of just got dizzy. He had some other kind of issues going on at the time, and he passed out. And I was amazed at the fast and the quick way that he fell, that I just tried to divert him from really injuring himself. So, you hear about people breaking their hips, you can understand why. And fortunately, in this case, hopefully not doing more serious damage in terms of having something like hitting their head on the floor type of scenario.
It is scary. And when something happens, it's an emergency.
Yeah.
You know, it's not a planned event. You are not going to get the phone call, it's Brian, next Wednesday, 11 a.m., I'm having a stroke, be prepared.
Right.
It's not, that does not
That
how it
doesn't
plays out.
happen.
That does not happen.
Unfortunately, we can't schedule it, right?
No, we can't. So then it becomes an emergency. You're getting the phone call. You're rushing to the hospital. Now you're dealing with doctors, hospitals, your medical insurance, and what are they going to pay for? What are they not going to pay for? And then the next thing you know, they're going to try to boot you out as fast as they can. And then what?
Right.
You're on your own.
Yeah.
Now you've got to figure out what type of care do I need? Where do I get care? What's good? What's not good? A plan of, you have to map out a plan of care. Nobody is equipped for any of that.
Sure. So what you're basically saying is that most of us have this mistaken notion of what is going to happen when we get to that point in our life, of what type of care is required to just do the daily living necessities. And what are those, by the way, for our audience?
I like to equate those to the things that each one of us do every single morning. We all wake up, we get up, we go to the restroom. That's transferring.
Okay.
We make it to the restroom. That's continence.
Okay.
We clean up afterwards. That's toileting. We take a shower, bathing. We get dressed, dressing, and we eat breakfast, eating.
It's amazing how consistent that is for every person alive, right? I
Right,
mean, we all
exactly.
basically have the same steps that we go through in that first 15 minutes.
Right. But think about what would happen, what would you do if you could not do at least 2 of those 6? What if you couldn't get up out of bed and get to the bathroom? What if you couldn't make it to the bathroom? What if you couldn't bathe? What if you couldn't feed yourself or get dressed?
Right, right.
What would you do?
Yeah.
Who would help you with that?
And that's scary to thought that, there are people right now that we're talking about that have that issue going on, and I don't know what they're doing. I mean...
And trust me, nobody wants their children bathing them and doing their toileting. That's not what they want.
No, I think most of us, don't even want to think about that.
No,
In fact, the whole notion of that topic is something that we want to just skip over.
I love my mother to death, but that's really not something I want to have to do for her.
So if our family members are going to be challenged in taking care of us, what next? I mean, who's going to take care of us if our family can't take care of us, if we don't have some other kind of financial help in that matter?
Well, a lot of people think that the government's going to step in and take care of them. They think that Medicare covers it. Not really. They think of, Medicaid. Medicaid is for the destitute, so you have to spend down your assets. And then you've got to be in a Medicaid qualified facility. It's not home care and it's not assisted living. It's a nursing home, and this is where people do not want to be.
Right, right.
Medicare, if you're lucky, will cover maybe the first 100 days, but there are so many hoops that you have to jump through, it's next to impossible. So really, you're on your own. This is going to end up coming out of people's retirement. Or they're going to become
exactly what they're not planning for. In fact, I have a case right now, a client, where unfortunately the husband had a stroke. 67 years old, just about ready to go into retirement, had pretty much put a lot of things in place. And unfortunately, long-term care wasn't one of them, nor was disability insurance as well, because he was still working. And I don't think his employer offered disability insurance to him as well. So here now is the wife, who I just feel so terribly bad for at this point, not only for him, obviously, because of his health condition, but for her, because her whole life is now turned into being a long-term caregiver. And I just don't think mentally and emotionally she was ready for this. And now here she is. She's 67, I think, or close to that age herself. And retirement is not going to be what she had envisioned for both of them, first of all. And second of all, it's kind of frightening a little bit what the future looks like for both of them in terms of, fortunately, he has her. But his condition, I don't know how well that's going to recover from. It was a double stroke in a short amount of time. So it's conceivable that he may be challenged by that for the rest of his life, which is really sad to me because, in my mind, as a professional, I kind of didn't think about that was a realistic scenario with what might be happening to some people at that early age and what we consider is kind of relatively young still.
Yes, still.
And now they're in a totally different situation. The other one that came up, which was recently as well, was the qualifications for getting care are more difficult than I realized. So many people that are waiting might find that, geez, they can't get coverage when they need to. So what happens? So I've spent down my assets. Unfortunately, these were assets of I had a huge sum of money that I was hoping to retire and enjoy life, and now suddenly I'm in a position where I'm spending that money down. What you're saying is essentially I could essentially spend it all down before Medicaid would pick it up.
Correct. That's it. You are allowed your home if you still have a spouse. Your spouse can live in the home. You're allowed the person that's going on care is allowed only $2,000. Their total assets. I mean, that's nothing.
Yeah, I know.
And then you're given an allowance of about $35 to $50. I think it might have raised this year a month for personal expenses. That's it. What can you buy with that money?
Nothing really, right? So
there goes my shampoo and conditioner, and now I've got nothing
not
else.
in California anyway.
Right.
Do you get to keep the house?
You can if you have a spouse. You do get to keep the house.
Okay.
But then you've got to worry about the Medi-Cal recovery
right.
coming back to take your assets once you've passed.
Right.
So
you're painting a pretty bleak scenario, it sounds like, that if we don't do some other kind of preparation in terms of trying to get some other kind of insurance or long-term care coverages of some kind, that we might be in a very challenged situation in terms of who's providing us the care. We're not in control of that at that point.
Right.
And also that we'll spend down just about everything we have before we can actually get onto some government aid or government program like Medicare or Medicaid. Yeah, not a very good scenario.
You don't have the choice. You are dictated to.
Right. Tell me a little bit about what your thoughts are on what people should be doing and how should they be approaching looking at long-term care. Particularly young people, I think, more so today, since they're going to experience, I guess, a parent that is going to be going through this scenario. And, the fact that people are living longer, we're all going to see maybe great-grandparents, parents, so forth, that are going to be dealing with this. So what's your kind of thoughts on how people should be looking at when they should start really taking a look at getting long-term care coverage?
Definitely, the younger you are, the healthier you are. Your money pays for it, but your health buys it. And so many times...
Money pays for it, but your health buys
Yes.
it. Interesting concept. Tell us about that.
Well, so many times I see people approaching their financial advisor and wanting long-term care insurance. And the reason why is because now they've had a health event, there's something going on. And so many times they're uninsurable at this point.
It's interesting how that happens, that we get triggered by an event, unfortunately as it is, and that's tragic because sometimes it's too late. But it's also sad to know that we've seen a friend or a family member go through some scenario, either maybe a disability, a tragic death, and now in this case we're talking about caring for someone that can't care for themselves. So you're saying that if we're younger, we can qualify. If we're older, even though we have the assets, it may be too late.
Correct. Again, because of your health. You don't want to wait too long. You don't know what's going to happen. Just like your friend with the stroke, you have no idea what's going to happen down the road. Even in a year, I've seen people put it off for a year and then have something catastrophic happen and they're now uninsurable. This is something that you can't put off. Again, if you're younger and healthier, you can get preferred ratings, you can save additional money on your premiums. But if you're sitting down with a financial advisor and you're mapping out what your retirement dreams are and how you can get there, you need to also put a plan in place to protect those assets.
Right.
And nothing can protect those assets like a long-term care insurance policy.
So let's talk about the health risks, I guess, in terms of what people are considering in terms of when they're looking at maybe the difference between long-term care and life insurance. We hear people getting life insurance even if they had maybe a a tragic, maybe even a heart attack or some kind of heart condition. So people think, well, if I can get life insurance, I should be able to get long-term care insurance, right? What's the difference in terms of the types of health conditions that might affect someone getting or not getting long-term care insurance?
In technical terms, it's the difference between mortality versus morbidity.
Those are two very technical terms.
Yes, and I will explain those. Mortality is anything that is going to cut short your life expectancy, cause you to die earlier than expected. Morbidity, that's the issues where you're going to become ill and need care. So not necessarily anything that's going to kill you. So the underwriting can be very different. I had an agent tell me, I've got a client, she got super preferred on her life insurance policy. So I think you should run her preferred for long-term care. And I, thankfully, because we had done the life insurance, we had the medical records. I went through the medical records, looked through them, and I had to call him back and say, I'm really sorry. She is not going to be a preferred risk. She'll be standard. So it's a very different thing that they look at, and they're very, very strict because people are living longer, people are needing care.
Right.
They are going on claim, those that have these policies, and staying on claim.
Right.
So the insurance carriers the whole entire industry has just been bombarded with claims, and this has just been a huge issue. So that's why we've seen a lot of rate increases on those older blocks of business. They're trying to make sure that they can pay out those claims in the future.
Right.
But that speaks to the importance of having a policy, because people will need care.
Right.
And if you don't have a policy in place to at least help pay for that, you're going to have to pay for all of that out of your assets.
What is a typical person might have to spend on long-term care for coverage? I mean, not coverage, but daily or monthly expenses. What would that be?
Well, the average length of claim is 3.4 years. And if you're looking at the total amount in today's dollars that you could spend on a 3.4-year claim, it's probably about $238,000.
Okay. So that's quite a bit of money.
It is. I mean, a home health care aide just to come in.
So you're talking about $70,000 a year, $80,000 a year.
Easily.
Yeah.
Now that's today's money.
For one person.
That's one person. That's today's money. But most people aren't going on claim today. They're going to go on claim another 15, 30 years down the road.
Mm-hmm.
And then where will costs be then?
Right.
Another 15 years, it could easily be close to $450,000.
Wow.
And I have seen statistics in 30 years saying it's going to be over $1 million.
Wow. I
Who
had
has
a
that
client,
money?
I had a friend that's in the business as well, and he was just telling me a scenario which is kind of very disturbing. The couple actually had 2 long-term care policies that would cover $6,000 a month each. So that would be $12,000. And apparently they structured it so it would be covered for 5 years. Mm-hmm. But because of longevity reasons and so forth, they've outlived the 5 years already. So now they're back to spending down assets. So not only did they take the precaution to get care and coverage, $6,000 a month for each, but even so, they're still finding themselves spending money down to pay for their coverages going forward.
I mean, that can happen. I mean, the difficult thing is that nobody has a crystal ball. We can't tell the future, so we don't know how long any particular person may need to be on claim.
Right.
They did a wise thing. I mean, a 5-year plan. I mean, 83% of policyholders do not exhaust a 5-year plan, but there are those that do, obviously. Mm-hmm. Usually that's due to a cognitive impairment.
Sure.
But at least they had $6,000 a month covered for 5 years. I mean, that is huge if you do that math.
Yeah.
They saved a chunk of their portfolio. So the fact that now they're having to dip into that, I mean, if they didn't have that policy, they'd be destitute.
Exactly. So back to the qualifications. So theoretically, what you're saying is someone that might be, say, had a heart attack. Let's just take that example because that's a pretty common health event. I think a fair amount of Americans will probably, unfortunately, have to experience. So if they had a heart attack, they may have some trouble getting life insurance. But in long-term care insurance, what would that mean in terms of qualification?
Believe it or not, you're a standard risk with a heart attack. As long as your heart functions are normal and you're recovered, even if you've had a few stents, I've seen up to 5-6 stents. be okay on a standard rate. So the issue is the fact that, unfortunately, from a morbidity standpoint, if something's going to cause you to pass away, that's not a claim for long-term care insurance.
Sure,
So that's
right.
not, they don't look at that
It's not
as,
really a big risk
it's not a
for them.
big risk for them, as opposed to something like osteoarthritis or osteoporosis, things that people don't think about, back pain, narcotic pain medications.
You know, it's interesting you're talking about back pain. I just read a statistic somewhere that 70 million Americans have some form of back pain. And in fact, one of the number one reasons why many Americans are addicted to some kind of pain medication is directly attributed to back pain.
Correct. I mean, it is scary to
Yeah.
think about. You know, I've had issues with my own back. I've had chiropractic care off and on. So it can happen. People get injured, serious things. They start having degenerative disc disease, stenosis, and that can be insurable. But once you get to the point where you're needing a narcotic pain medication on a daily basis, now you're uninsurable.
So, really, you're uninsurable.
You are uninsurable because of the narcotic pain medication.
Okay.
Or if you've got a severe degenerative disc disease or anything that says severe in the medical records for something like that, because that puts you at a higher risk for a claim. So the underwriters do not like to see that. If it's mild or moderate, and if you're fully functional and not on a daily narcotic pain medication, then yes, there's a good chance that you're going to be able to get through underwriting and be able to get a policy.
You know, it's interesting you talk about that. I had a client that had some problem with her foot, and they had foot surgery. And they were on pain medication for just a brief period of time, maybe a couple of months, just to kind of recover. And they wanted to get long-term care insurance, and they were told you should probably wait another 12 months or so to get full clearance from their doctor saying that they were not needing pain medication going forward. Is that kind of a rule of thumb, or is that just, it depends?
It can depend upon what the issue is, but for the most part, if you've been on a narcotic pain medication for an extended period of time, you know, if it's just been a couple of weeks after surgery, that's one thing. But if you've
Right.
gone into the months, then yes, once you're finally weaned off of that, then an underwriter may want to just make sure that there's no dependency, that you're not needing that the pain is fine. So they can put a time limit of anywhere from 6 to 12 months that they want to see stability
Right.
before that they would consider.
So you're young, and you know, so I think, you know, when you're talking about, and you expressed that you've had some back issues, and I as well, and so not that I'm on any pain medication for it, but it is more common than we think with people that are, say, maybe not even in their 60s, perhaps in their 50s. And so what you're suggesting potentially is that people need to rethink about when they try to get covered. They should be thinking about in their 50s and maybe
Even their 40s if
even
it's
their
possible.
40s, if it's possible.
And start small. You don't need to buy anything that's, you know, large and is going to cover everything. You know, most people in their 40s are still dealing with kids with college, so they're trying to fund their retirement. But start with a small policy. Get $100 a day, 3-year, and maybe not even any inflation. Just get something to start with. You can build on that later and down the road.
Right, right. So let's talk about some of the options, some of the alternatives people might want to consider for getting some coverage. You mentioned starting with something small. What would that look like, and how would somebody think about it, maybe someone in their 40s or maybe on a different financial level, you know, maybe as another comparison. What's the way to approach trying to decide what is the best coverage for yourself?
Well, there are a lot of options now. It's not just traditional long-term care insurance, although that's what most people tend to think about.
Okay.
So if you're younger and definitely trying to still fund a lot of, you know, your retirement and kids' college, things like that, then it may be the best scenario, maybe a small traditional long-term care insurance policy, like I said, just a small $100 a day, $3,000 a month payout for maybe 3 years. And again, don't even add any inflation on that, just to have something to help.
And how long do you pay that for, typically?
Typically, that's the premiums are paid until you either do one of two things. You either go on claim or you pass
Okay.
away.
Okay.
Now, we do still have a carrier that will offer a 10-pay scenario. So
Okay.
you pay an increased premium for 10 years, and then your policy is paid up.
Right.
If you can afford that, that's really the way to go on a traditional, because after that 10-year mark, they can never come back to you and ask you for more premium. So you're protected from future rate increases down the road.
Well, that doesn't sound so bad because, I mean, we're used to paying for life insurance, and we pay that pretty much our whole life, right? We pay for
Correct.
car insurance our whole life.
We pay for medical insurance that goes up each and every year without complaint.
Yeah, right.
Well,
And we
maybe
just
not without complaint.
Without
but
complaint, yeah. And we know that's pretty substantial, and we just assume that's what you do. And for some
Exactly.
reason, this one is not one of them that we think about.
Right, you just hit that psychological wall where most people think, well, I'm never going to need it.
Yeah, it just still baffles me why so many people just really are not even thinking about this. And you know, since the baby boomers particularly are coming closer and closer to retirement, that it's not even on their radar. It's just,
Well, most of them aren't thinking about it because no one's talking to them about it.
mm-hmm.
Their financial advisors
It's a
never
huge
bring this up.
education problem,
It
huh?
is a huge education problem. And people need to understand that we can make it affordable, and there are many different ways to fund a policy. Again, there's traditional long-term care insurance. We also have what we refer to as linked benefits, which are asset-based.
Okay.
So life with long-term care component, or even an annuity with a long-term care component built in.
Those are quite a bit of different options, aren't they?
Exactly. Then you've got just your regular life insurance policies. You can add a long-term care insurance rider on. You need to make sure and really read the language on the rider to make sure that it's an actual long-term care rider and not a chronic illness rider. There is a little bit of difference.
And how does that look like in terms of comparing affordability? Which one would you consider using based upon your financial, wherewithal?
Affordability still is going to come back to a traditional long-term care insurance policy.
Okay.
It obviously, if you're doing a linked benefit, you're paying for the life insurance or the annuity, as well as having that long-term care portion. But a lot of people don't like to buy a traditional long-term care insurance policy because they don't think that they're ever going to need it, so they don't want to waste their money. They feel like they're throwing away their premium dollars.
Right.
So if they have an asset base, a life insurance with an LTC component, if they don't ever use the long-term care insurance, they pass away, now their heirs have a tax-free benefit.
Sure.
So they have really leveraged that money that they've put into that.
So you're talking about, in that case, like you said, an asset-based type of policy, like a life insurance contract, and you would be dropping in a certain amount of money into what we call the cash value, and that would be used potentially for long-term care benefits as well as for funding a life insurance policy.
Correct. You get, depending upon, there are a couple of different products, but you're
Okay.
definitely getting a death benefit that you can pretty much accelerate. So you think about an accelerated death benefit rider, that's
Okay.
pretty much how it works. It's going to
Okay.
give you a monthly amount that you
Right.
can utilize, and then that will come out of your death benefit. And then there are extension of long-term care benefit coverage that you can add to that. That gives you a bit more long-term care coverage. So if you've gone through your death benefit, then you can still have some long-term care coverage. We still have one plan that you can actually do unlimited. It's the only unlimited policy left in the industry. And in California, it is so unbelievably well priced, and they've got it filed to make that change. So now is really the time to buy.
To buy.
Do not wait.
Okay.
It's not ever going to be any cheaper than it is right now.
Right. So what about a person that maybe has plenty of assets, has money sitting in a bank account that's earning maybe less than 1%, unfortunately? What would you consider for that scenario?
Most people have money put aside for an emergency.
Okay. Yeah.
So they've got money, like you said, sitting in a savings account, in a CD, a money market. Those accounts really aren't earning anything, but it's there. It's as a savings, as an emergency fund.
Right.
What about taking a portion of that and funding a single premium asset-based policy? Now you're leveraging your money. Now you've
Okay.
got a tax-free death benefit. If you die with that money's taxable to heirs.
Right. Right. And suppose you don't actually need to use the money. I mean, actually for long-term care, and maybe, I don't know, you're not sure that you're going to need life insurance either. What happens with that?
Well, then again, you've got an annuity. If you
Okay.
think about, planning for retirement, if you do a pension protected
Sure.
annuity, then you can pull money out for a long-term care event if needed, tax-free. If you have a regular
Tax-free.
annuity, it's going to be taxable.
Okay.
So you can pull that out tax-free again, then you can still have, your annuity income if needed, so as part of your retirement plan. So there are a lot of options. It's really important to sit down with the client and really discuss what's most important to them and find out where their money is.
Right.
Maybe we can reposition a few things, take a non-Pension Protected Act compliant annuity and roll that into a Pension Protected Act annuity and give them that added tax, benefit. Sometimes they have cash value life insurance that they're not really thinking that they're really needing. So maybe we can put that over and really maybe leverage more on the long-term care insurance side.
Sure.
Because they've already got that, it's not costing them any money.
Right.
Maybe then if there's any type of a deficit, we can do, a small traditional long-term care insurance policy to buffer up against that. But it's just important to make sure that you're talking to your advisor.
Right.
Talk to someone, talk to your family. What plan do you have in place should an extended health care event occur?
Right. So there's a lot of options there, what you just talked about there, quite a bunch of different decisions as to what you might decide to do or not do. How can CPS help people in this area? I mean, particularly, I guess, advisors in terms of, facilitate in terms of helping them educate both their clients as well as become better educated about, the long-term care needs and issues going forward.
We have experts in every line of business. So obviously, I am in the long-term care insurance department. I have 21 years of industry experience. We have disability specialist, annuity specialist, life insurance specialist.
Okay.
So we will sit with you, we will talk with you, we will help you get the information, we will discuss the client with you, we will do conference calls with you and your client to help make sure that we match the right product with that client's individual needs.
So that's a
make it
great
affordable.
resource, because I think there's a lot of professionals, including myself, that are knowledgeable about some of these choices and options, but frankly, in terms of making the decision as to which one's best for a client and how that matches up against their financial needs and requirements, I mean, that's a lot of different choices to make. So to have a resource like yourself, I think would be very beneficial to different professionals starting with, and then ultimately for the clients. Do you actually ever meet with a client as well with an advisor?
Yes, I do.
Okay. Well, fantastic, Therese. Thank you very much, and I appreciate you joining us
Thank
today.
you for having me.
Yes, great news. Okay, well, you've been watching the Financial Freedom Show. I'm Brian Connors, Certified Financial Planner and Financial Advisor with MPB Financial Group in Irvine, California. If you need help with your financial plan for retirement, we're all going to arrive at our retirement years sometime, so we might as well get started today. The question then becomes, are you going to have a solid plan when you get there? If not, and not sure about that, schedule an appointment with us. Call us at 949-271-6433. That number again is 949-271-6433. Or you can go to our website, npbfg.com. The MPB Financial Group. We deliver financial security and peace of mind to clients every day. Join us next week for another edition of the Financial Freedom Show. You can also watch other Freedom shows at financialfreedomshow.net. Until next time, take care, take action today to set yourself financially free.
The information in this presentation is not intended to provide tax, legal, insurance, or investment advice. The information, opinions, or recommendations are solely for informational purposes, constitute the participant's best judgment, are only valid as of the date of this presentation, and are subject to change without notice. Investment information in this presentation is not an investment recommendation or solicitation. The participants are not advising you personally, and such information is impersonal and is not tailored to any specific person. You should consult a qualified investment advisor regarding your specific personal financial and investment decisions, and consult an attorney or tax professional regarding your specific legal or tax situation. C. Brian Connors is a certified financial planner and an investment advisor representative with NPB Financial Group, LLC, member FINRA, MSRB, SIPC. He is licensed with the California Department of Insurance number 0661999.